Welcome to the Explainer. Today, we're digging into Tesla's latest financial report. And honestly, it's a bit of a mystery. How can a company sell more than ever, yet end up with less profit? That's what we're here to figure out. Let's jump in.
So here it is, the central puzzle of this whole report. Revenue is up 12%. Great. But profit? That's down a whopping 37%. I mean, how does that even happen? You sell more, but you make less? Something's going on under the hood here, and we're going to get to the bottom of it.
All right, so here's our game plan. We'll start with the puzzle itself, then break down the auto business troubles, check out a surprising bright spot in their energy segment, touch on some pretty wild paycheck and lawsuit drama, and then wrap up by looking at what's next for Tesla. Let's get started.
Okay, first things first, the financial puzzle. Let's look at these two numbers that are telling completely different stories. Okay, so take a look at this. The top number, total revenue, is up to $28.1 billion. That's a solid 12% increase. You'd think that's a reason to celebrate, right? But then you look at the bottom number, the net income, the actual profit. It's fallen off a cliff, down from over $2 billion to just $1.37 billion. That is a huge drop, and it completely changes the story.
Yeah, a 37% drop. That's not just a small dip. That's the whole ballgame right there. It means for every dollar of sales coming in, a lot less is sticking around as profit. So to really understand why that's happening, we've got to peel back the onion and look at their biggest segment, the car business.
All right, section 2, trouble in the auto business. Now, cars are the heart and soul of Tesla, right? It's what they're known for. But it looks like that engine is sputtering a little bit.
Okay, before we go any further, let's quickly talk about one key term you're going to see, gross margin. Don't worry, it's simple. Just think of it like this. For every car Tesla sells, how much profit do they make just from building and selling that car before you subtract things like R&D or marketing? It's a really pure measure of how profitable the product itself is.
And boom, here's the smoking gun. A year ago, that gross margin was over 20%. Pretty healthy. But now, it's down to 17%. Now you might think, 3%, what's the big deal? Well, when you're selling billions of dollars worth of cars, a 3% drop is a massive, massive deal. It means less cash from every single car that leaves the factory.
So the natural question is, why? Why is it dropping? Well, the report lists a few reasons. Things like factories not running at full steam, tariffs, selling more of their cheaper cars, all that stuff adds up. But there's one reason in particular that really stands out.
And it's this, regulatory credits. This is kind of like Tesla's secret weapon. Because they only make electric cars, they earn these credits from the government, which they can then sell to other car companies that are still making gas guzzlers. It's almost pure profit. Well, that source of free money just fell by 44%. We're talking a loss of over $300 million in almost pure profit. Ouch. That really hurts the bottom line. But, okay, it's not all doom and gloom. Because while the car business is hitting some bumps, there's another part of the company that is absolutely crushing it. Let's talk about the energy segment.
Just look at this chart. The difference is night and day. The giant auto business grew by 8%. Not bad, but then look at the energy business, 44% growth. That's not just growing, that's exploding. It's going 5 times faster than the car side.
And here's the real kicker. It's not just growing faster, it's also way more profitable. The gross margin for energy is over 31%. That's almost double what they're making on cars. So yeah, the auto business is still bigger. It brings in more cash overall. But the energy segment is the fast-growing, high-profit engine right now. It's really starting to look less like a side project and more like the future of the company.
So you've got this fascinating split, right? Cars struggling, energy soaring. But the story of a company isn't just in the spreadsheets. It's also in the boardroom and in the courtroom. And believe me, this report has plenty of drama on that front.
Yeah, get a load of this. Buried deep in the report, you find this little nugget, a new stock award for the CEO. The value? $26 billion. I mean, that's just a mind-boggling number. It's hard to even wrap your head around.
But here's where it gets really interesting. This isn't just a straightforward payout. It has this weird legal thing called a no double dip clause. What does that mean? Well, it's basically Plan B. See, there's a huge court battle going on over an old pay package from 2018. If the court says that old package is valid, this new $26 billion one just vanishes. It's their way of making sure he doesn't get paid twice for the same thing, no matter how the court case turns out.
And speaking of court cases, that pay package fight is far from the only legal headache Tesla's dealing with. I mean, the list is long. You got lawsuits over autopilot and full self-driving promises, major discrimination cases, and even stuff still lingering from that whole going private tweet storm a few years back. Each one of these is a potential landmine for the company.
Okay, so we've seen shrinking profits on cars, a booming energy business, and a whole lot of legal drama. Where does this leave Tesla? What's the road ahead look like?
Well, if you read what management themselves wrote in the report, they're pretty upfront about the challenges. They talk about rapidly evolving trade and fiscal policy and uncertainty in the market. That's corporate speak for, hey, things are kind of crazy out there, and it could mess with our supply chain and our costs. They know the road ahead is bumpy.
All right, so let's boil it all down. What are our key takeaways? First, don't be fooled by the rising revenue. The core auto business is getting less profitable. Second, the energy segment is the real star of the show right now. It's smaller, but it's growing like a weed and making great money. Third, there's a ton of risk swirling around the company, from that massive CEO pay package to all those lawsuits. And finally, the future is all about managing these external pressures while trying to innovate. It's a real balancing act.
Which brings us to one final big picture question. We all think of Tesla as a car company, right? But looking at these numbers, with the energy division on fire and so much focus on AI, you have to wonder, is Tesla's future really about cars? Or is it becoming something else entirely? A battery and software company that just happens to sell cars? It really feels like its identity could be shifting, right here, right now.